Chapter 1, Defining Objectives. In this chapter, we are going to help you to define your objective from the stock markets. And this is important because this underlines your why of the action plan you will be building to make money from the stock market. Imagine yourself sitting in a train and you don't know where the destination is. You wouldn't know which stop to get down at. And that's why it's important for us to know what your why is, what the underlying why is, so you know what kind of plan to build in the market for yourself. For example, if you're looking at applying for an IPO just for listing gains, which in the most recent times people had invested and applied for Paytm IPO because it was trending, it was oversubscribed, but that IPO listed in a discount. That means it listed below its issue price. So there were no listing gains, rather negative returns for the investors who were allotted the Paytm IPO. Now in this case, if investors have invested just for the listing gains, but because the listing gains were negative and you don't have clarity what to do next, in that terms, you tend to become a long-term investor just on the basis of hope. Welcome to Chapter 2, Risk Management. Risk management is an important topic when it comes to stock market investing or trading because this is what makes or break a trader. By learning simple and effective tools of risk management, we can ensure that we do not get emotionally or financially drained from the markets. Just imagine that you've entered the market with all the enthusiasm. The first trade you take, it goes in a profit. The next trade goes in a profit. The third trade goes in a profit. The fourth trade goes in a profit. How does that make you feel? Good? Yes. Excited? Yes. Confident? Yes. Very close to overconfident? Mostly yes. And what can happen usually here is the profits you have made in the 4 or 5 trades, which has helped you increase your capital at that time, what you can end up doing is taking a big next trade, and that trade, if goes into a loss, it can potentially take away all your previous profits or harm your capital also. Welcome to Chapter 3, Compounding Capital. Now, be it an investor or be it a trader, our goal is to multiply our wealth from the stock market. For that, we need to focus more on the compounding returns than the one-time return. For example, you may feel like a FOMO, fear of missing out, when a couple of stocks your friends or your brokers may have suggested and you have not invested in those and they have given like 40, 50 or even 100% returns in a very short span amount of time. But it's absolutely okay that there are more than 6,000 stocks traded in the market. Every trade is an opportunity and it is impossible to catch every opportunity. What we need to focus is on whether our strategy is matching our goal or not, and whether that is effective for a sustainable long-term growth. Welcome to Chapter 4, Taxes and Brokerage. Now these are the two terms which can either protect your profitability or eat away your profitability, depending on how you understand and manage them. Let's talk about taxes first. Different segments of the stock market are taxed differently. For example, let's start with intraday trading. Intraday trading is where you buy and sell on the same day. When you're doing this in cash segment, it is treated as a speculative trade and it is taxed at 20%. Your gains are taxed at 20%. Similarly, if you are doing intraday in derivative segment, say future and options, it is also treated as speculative gains and treated at a 20% slab rate. On the other hand, if you are buying a stock and taking a delivery in your demat account,